Welcome back, everyone, to Property Ponderings. We've got another exciting episode for everyone today. We are talking about tax planning. I know for some people it may put them to sleep, but it's a vital part of everyone's strategy. And today we have a very special guest joining me, Sam Geilings. So welcome along.
Thank you. Thanks for having me. Sam's
from Geilings Grimwood Accounting in Melbourne, and they've been doing my tax for a number of years and a lot of people that I know. So I thought it'd be a wonderful opportunity to get Sam on, who has had around 20 years experience in accounting. He's a chartered accountant and knows his stuff. So I thought it was really valuable for everyone and listeners to get him on, and we can ask him some really relevant questions to everyone that's starting their property journeys or slowly building up towards a bigger property portfolio, which Sam's been there for me along that journey as well. So again, welcome along, mate. We'll get you started here with the first question, which is related to some tax strategy for buyers. So for those purchasing properties, so nice general one, what sort of tax benefits or deductions should they be aware of, especially for investment properties versus, say, your primary residence?
Well, good question to start.
Straight into it, mate.
Straight into it. That's the way we roll. No, look, obviously the main deductions you're going to want to claim on your rental property are obviously your interest, council rates, water rates, repairs and maintenance, and things like that. Now, depending on also how new the building is, if it's a new building, then there's depreciation, amortisation, and things like that we can claim if we get a QS report. That we can claim as well, and they can be quite significant deductions, especially early on.
Yep.
The older the property is, the quantity surveyor's report probably isn't as relevant because you're probably not going to get massive deductions. But then again, you're probably going to have more upkeep and repairs and things like that to try and fix up those older properties as well. Yeah. So look, they're the main ones. There's obviously even things like if you have cleaners coming through or gardeners and things like that, all those little things. What I normally say to people is anything you spend on the property, keep a receipt, and then we can decide whether we can claim it or not.
Yeah, work it through. Because there are some grey areas with things. I know especially with, say, repairs on a property. What is a repair and what is just, say, adding value?
Yeah.
A big part of the podcast for me and my strategy is renovation. So there's some grey areas
there's a lot of grey areas when it comes to repairs and maintenance versus an improvement.
Yeah.
There's probably hundreds of cases on all this sort of stuff that's been through the courts, and no one really can get a definitive answer.
Yeah.
So it's horses for courses in a sense. That's the basic rule is if you're literally just replacing what you had there before, that's pretty much a repair.
Okay.
If you're buying something that's an upgrade, then that's where it starts to get a little bit grey on more of an improvement side of things, and you have to depreciate the item rather than write it off straight away. So obviously you want to repair because you get the immediate deduction for it. But and the ATO really is the last few years targeting those sort of areas in terms of improvements versus repairs.
Okay.
And we've had like a few, not audits, but just a few questions asked about certain items and things like that.
And then at that stage, does it become subjective from their point of view? Or?
It is.
Yeah.
And I guess documentation's the key with all this sort of stuff when you've got the ATO involved. So if you've got a good invoice that says it's replacing something instead of a new item, so if you can sort of get whoever's helping you out to word the invoice in a more repairs side of things to a improvement, then that obviously helps. But documentation's always the key with this sort of stuff.
Yeah.
So keeping all receipts and invoices is a basic 101.
Yeah. Well, look, I've definitely gotten better at it over time, knowing I have little folders that I can put it straight into on my phone and everything to make it easier.
Yeah.
But no, it's a really good tip. And the other thing is I was going to ask is between, say, interest, repairs, depreciation, what are you seeing, or what do you normally say is the most common, is the biggest deduction?
Well, it was an interest for the last few years, obviously, with interest rates, but now interest rates are a lot higher. So interest has become probably the major deduction again, and it probably was 5 or 6 years ago before the rates started coming down.
Yeah, okay.
But look, interest and depreciation are probably your big ones on your properties. And I think they're the two main ones. But repairs and maintenance, it varies from house to house and unit compared to a standalone house as well.
Yeah.
Yeah, but interest is the big one at the moment.
Yeah, cool. You did mention depreciation
Yep.
benefits in there. I know it's one that gets people a little bit confused, or they're not really sure how that works.
Yep.
So can you explain that a little bit further?
Yeah, so I guess depreciation there's two separate ones. So there's depreciation, which is depreciation on your assets, so like your hot water service or an air conditioner you buy. And then there's what they call a capital works deduction, which is actually depreciation of the building itself.
Yep.
And that's at a 2.5% rate over 50 years. And then the depreciation's depending on what asset it is, it's a different rate. So a hot water service could be 20% a year sort of thing.
Yep.
Now, if generally you'd get a quantity surveyor's report and they basically go through the house or the unit and go, all right, this is what the building costs were, this is what all the fixtures were, here's your report for the next 20 years on what you can claim.
Yep.
For a newer property, you're obviously going to get a higher deduction because the building costs are a lot higher and a lot newer.
Yep.
Than an older property that's been there for 30 or 40 years and there's not much left in the capital work side of it. So that's probably the main difference. But you've also got to be careful with claiming depreciation and writing assets off at the same time.
Yeah.
As well. So that's another sticking point is sometimes you buy an air conditioner and think, oh, that's a repair, but it's not. You're actually replacing an asset that you have to depreciate as well.
Okay.
So you can't just write it like an air conditioner or a hot water service off like as a repair.
Yeah, okay. Yeah, it's a different way to treat that. Okay. Yeah, well, there you go. So there sounds like there's a lot of different, there's lots of intricacies with tax in general. There
is, and I think people underestimate, especially with rental properties, the nuances with repairs and improvements and depreciation and capital works and things like that. So handy to get a tax accountant to help you out on that side of things.
Yeah.
And also with the depreciation, the capital work side of things, you've also got to keep in mind that actually comes off your cost base of the property too, so that when you sell it, your capital gain might be higher than what you expected as well.
Yeah, okay.
Yeah.
Okay.
So that's the other trick. So you might have bought an apartment for 400, but you've depreciated 200, so your cost base is actually now 200, not 400. Yep. So your capital gain will be higher in that sense. So that's what a lot of people don't sometimes understand with the capital works write-off. So you're getting a deduction up front, but in the long run, it sort of evens out over the long run.
Yeah, okay. So that could be especially relevant for people that are chasing depreciation as a core component of their strategy, right?
Yep.
People go, I'm going to buy this new apartment because it has great depreciation on it. And then if they go to sell it, they're going to be working from a completely different cost base
to what they probably expected in the first place.
Yep.
Yeah. So
it's a bit of a warning there.
It's a bit of a warning. Just keep that in mind that when you're depreciating it, it's actually coming off the cost of the property.
Yeah.
So your capital gains probably will be higher in the long run.
Yeah. Yeah. And just for the listeners as well, the depreciation report that gets done, I think the last few I did were around $700 or $600-700.
Yeah, most firms are about that $600-700 mark. Yeah.
And they normally won't do it unless you actually have something that you're going to be able to claim.
Correct.
Right? Yeah.
Yeah. So
to make it worthwhile.
If you say the house is 30 years old, they'll probably go, well, it's probably not worth it.
Yeah.
Whereas a brand new apartment, they'll be like, yep, definitely.
Yeah, bang, let's do it. Yeah.
Absolutely.
Yep. All right. Question number 3, Sammy.
Mm-hmm.
So we're going to talk about capital gains tax tips for sellers. So when people are selling a property, what are the main ways sellers can legally reduce their capital gain tax liabilities?
Good question. Get this one a lot.
Yeah.
Obviously, your main costs to reduce your capital gains, obviously your selling costs, like your commission for real estate agents and legal fees and all your costs, even staging costs. So if you stage a house, we can offset that.
Yeah. What if you have to fix something or do that's still the same, right? So if you go and you paint a wall, you can't claim that if it's not a repair.
Yeah. This is another grey area between is it a repair while someone was living there or is it capital which would add to the cost base, which still you're getting it reduces your capital gain, but you kind of want it to be a repair and reduce your income up front sort of thing. So, yeah, again, that's a tricky one because especially people that have kicked the renters out or, haven't had anyone tenant the place for a while and they're doing all this work, you can't really claim it as a deduction if there's no income coming in the other side.
Yeah.
But, as I said, you can claim that against the capital gain. Like that adds to the cost base of the house.
Yes.
So if you do a bit of a reno, doing up a bathroom or a kitchen or something, that adds to the cost base, reducing your capital gain. So you don't lose that.
Yeah. Okay.
That improvements. That would be considered an improvement.
So it's reducing your capital gain that you may have to pay.
Yeah. So if you spend $20,000 on updating the kitchen or something before you sell it, that obviously adds $20,000 to your cost base and reduces your capital gain.
Yep. All right. So I think I cut you off there, but when you were talking about some strategies that you tell your clients all the time.
Yeah.
Do you have any more on that one as well?
Oh, just some strategies. I guess, again, it comes back to just keeping records of everything that you've spent. So even if you go to, a lot of people try and do up the house themselves and, instead of getting people in to save cost, going to Bunnings and, buying some paint or buying some stuff for the garden, make sure you're keeping all those receipts. I think that's the biggest thing you can do is just keep everything. And then, as I mentioned before, bring it all into accountant or whatever, and we'll go, yep, all right, we can claim all that or we can't claim this. And claiming everything you can is the main thing, and keeping a record of it.
Yeah, and that's through the whole journey.
Through the whole journey. So, I don't know if you've got this question later, but holiday houses and things as well, there's different stuff you can claim. Even a sort of rental property, you've got to pay capital gains tax on it.
Yeah.
If you sell it, so there's different things like council rates and things you can add to the cost as well along the way. So you can reduce your capital gain.
Yes.
So, there's different things for different scenarios to claim. So keeping records of all that stuff is the main thing.
Okay. Well, we might have to talk about that one a bit later. Choosing between sole traders and limited companies. So for property investors, is there an advantage to holding properties personally versus in company structures? And
yes and no. There's pros and cons. I was talking to someone the other day about this. There's no perfect structure for property investment because if there was, everyone would do it.
Yeah.
And everybody's got different circumstances. Some people might want a positively geared rental property, others want negatively geared rental properties. So that's where it becomes, if you're earning a good wage and you want to negatively gear your property to offset your other income, then in your personal sole trader name would be the way to go.
Yeah.
If you want a positively geared property where you've got some spare cash where you can buy a house outright or minimal mortgage, and you just want positive cash flow, then through a trust would be probably more beneficial.
Okay.
Being able to split the income between your spouse and, other family members.
Yeah.
Companies are we don't see it as much anymore because there's no capital gains discount in a company when you sell the property.
Yeah.
So even though you might only be paying 30 cents on the dollar, overall, if you hold the house or apartment for 12 months in your own name or in a trust, you get a CGT capital gains discount of 50%.
Yeah.
So even if you're on the top marginal rate, you're effectively only paying tax at 22.5%. So you're actually better off in the long run, capital gains wise, to have it not in a company.
Yes. Okay.
And so, you can have it in the one way it would work is if you're not going to sell it ever and it's a, family home or something, then there's other reasons for it. But generally, we don't advise having it in a company.
Okay.
Unless it's a specific reason.
And so, what are the specific reasons, or what are some of the general reasons why?
General reasons. Well, again, it'd be more around if it's a long-term investment and you're on a high marginal rate and everyone in your family's on a high marginal rate of tax.
Yeah.
You can cap the rental income at 30%. Basically.
Okay.
So that would be the main reason for it.
Yeah.
And you're happy to cop the capital gains hit later down the track. Also, getting the money out of a company sometimes can be difficult, and having to pay dividends and things like that when you take the cash.
It's a bit more complicated.
It's a bit more complicated than getting it out of a trust or obviously in your individual name. So there's another layer of actually getting the cash out of the company as well.
And you've got the upkeep of the company.
And then you've got the annual ASIC fees, which are now $330 odd or something, plus the ASIC
The
upkeep,
financials
financials and tax returns. And I mean, even if it was in a trust, you'd still have tax returns, but you don't have the annual fee of $300, $350 per year.
Yeah.
It's just a trust. Once you set it up, it just does its thing, sort of thing.
And do you think that people come to you when they're trying to overcomplicate things, or they're wanting to, or?
Sometimes, yeah. In fact, a lot of people come in and say they want to buy an investment property and what's the best structure, and I want to do this and I want to minimise my tax, and it's like, okay, but what's your long-term goal? Do you want to sell it? Do you want to keep it? Is it going to be, are you going to have 2 or 3, or what's your plan? So you really need to take a long-term approach, because things can change. Like obviously early on, when a house or an apartment's negatively geared, you want it in your name to reduce your other income. But then when it becomes positively geared, you want it in a trust or something to split the income. So it's what your long-term sort of vision is for that property.
Yeah, it might not be ideal for that starting part of the portfolio.
Correct.
Yeah, but it will eventually get there.
Eventually. So if your idea is to have them negatively geared now and buy a couple of properties and, you know, have it negatively geared and put them in a trust, obviously the losses can't come out of the trust. They just have to sit there. But then in the long run, if you're going to keep them for 20 or 30 years, and once the mortgage is gone and whatnot on those properties, then there's tax benefits in the future for that way. Obviously, you don't get the offset of your income up front, but later on you will, sort of thing. So it's, as I said, there's no perfect structure for tax for an investment. For the entire life of the investment. Like generally, if you've got an investment property, you're going to hold it for a while, generally. If you're going to flip them and stuff like that, then you can go through a trust maybe a little bit more, or individual name a little bit more. It just depends on income levels and certain circumstances for everyone.
Yeah, and I guess there'd be times where people haven't planned it that well or haven't spoken to you early enough. Yes. And then they're trying to change it later. Correct. Which is expensive.
It can get very expensive because if you change ownership, even though... So if you've got it in a trust, for instance, and you want to put it into your individual name, then you've got stamp duty implications and obviously legal fees and things like that. So changing ownership of a property after the event is a lot more expensive than trying to get it right the first time.
Yeah.
Which again, you crystal ball these things and circumstances change, and it's So,
you do the best you can.
Yeah, and that's at that point in time that was the advice, and that was right. But 5 years later it might change and things happen, and separation and all that sort of stuff, which we're seeing, unfortunately.